Lesson 5: Unraveling the mysteries of bid, ask, spread, liquidity, volume, and slippage. Welcome to Trading Club 7U, where we break down complex trading concepts into simple, easy-to-understand lessons. As a beginner trader, are you tired of feeling like you're playing a game without knowing the rules? Today, we're going to tackle one of the most critical, yet misunderstood aspects of trading: the bid, ask, spread, liquidity, volume, and slippage. Imagine buying a car from a dealership. You see a car that you like, priced at $10,000. The salesperson tells you that the seller of the car wants $12,000, but is willing to sell it to you for $11,500 because they're eager to sell it. The price at which you want to buy, $11,500, is called the bid. But in this example, your bid price of $11,500 is actually lower than the seller's ask price of $12,000, because you're willing to pay less than they want to get for the car. The price at which the seller is willing to sell, $11,500, is not called the ask in this case, because it's your bid, not theirs. The difference between the seller's ask price and your bid price is the spread, which in this case is $500. However, this example is not typical for trading, where you typically bid below the sell price, or ask price, and the seller is asking below the buy price, or bid price. In that case, you have to think in terms of the seller asking high, and the buyer having to pay more for a lower price to get the seller to agree. Now, let's apply this to the trading world. Imagine buying a stock at 50. The bid in this scenario would typically be below the asking price. The bid is the highest price that someone is willing to pay for that stock, and the ask is the lowest price that someone is willing to sell it for. The spread is the difference between these two prices, which can be several dollars. Liquidity, volume, and slippage are all related to the bid and ask prices. Liquidity refers to how easy it is to buy or sell a stock without affecting the price. Volume refers to the number of shares traded in a given period. And slippage refers to the difference between the expected price and the actual price you pay when entering a trade. Think of it this way: imagine you're at a concert and tickets are $20. If you're the only one buying tickets, the ticket price is high and liquidity is low. But if you're part of a large group buying tickets, the price might dip to $18 because there's a lot of demand, and the concert venue wants to sell as many tickets as possible. Now, let's say the price is $18, and the ticket vendor is getting $19 from the other fans, because they've sold some at that higher price earlier. That would mean the spread is 1 per ticket, and the liquidity is high. Now, let's talk about why this matters. If you're buying a stock at a high price, you're paying more than you need to. And if you're selling a stock at a low price, you're leaving money on the table. But what are some common mistakes beginners make when dealing with bid, ask, spread, liquidity, volume, and slippage? One mistake is buying or selling at the wrong time, based on incomplete or inaccurate information. Another mistake is not understanding the spread, which can eat into your profits. To avoid these mistakes, make sure you're constantly monitoring the market, using tools such as charts and economic calendars to stay informed. Also, understand the concept of the order book, and be aware of the different types of orders that can help you execute trades at the best possible price. For example, imagine you're in a market with low liquidity, and the ask price is 50 for a stock, but the bid is 35. This means you can only buy at 50, and can only sell at 35, and there is a 15 difference. But then a large buy order comes in at a higher price, and the ask price jumps to 55. Now you can buy the stock at 55, which is much lower than the ask of 50 earlier. But a large sell order hits the market, and the bid price drops to 30. Now you would have to sell at 30, which is much higher than the bid price of 35 earlier. Practical exercise: open a demo trading platform, or use a paper trading journal, and practice buying and selling a stock over several price levels, taking note of the bid, ask, spread, and any changes in liquidity and volume. For example, imagine the ask price for XYZ stock is 10,000, the bid price is 9,000.